Well, thank you everybody again for joining us this morning. Today's webinar should take us about 20 to 25 minutes, and we'll definitely leave some time at the end for Q&A. Today's agenda is as follows. We'll talk a little bit about SCF, who we are, what we've done, and where we're headed. We'll then get into some of the solutions that SCF offers, particularly focusing on our unique PV plus ESS plus EVC offering. We'll follow that up with some recent data regarding EV charging and overall the growing need for EVC infrastructure, as well as the types of sites that we're targeting. And then we'll finish up with an example project, a brief showcase of how you, an EPC or developer, can price your own projects using our model, and a run through of how we can work together to keep these projects to an efficient timeline. So let's begin. So we are SCF, or Sustainable Capital Finance. We're a third-party financier, historically providing PPA offerings as well as development services to our EPC partners. Our EPC partners, which currently sits in the 300 plus range, actively submit projects on our financing platform, the SCF Suite. From there, they're able to price their own projects, generate proposals to present to off-takers, and ultimately track their project from concept to completion as our team works with them to complete all necessary components of an opportunity to successfully reach COD or commercial operation. Historically, we've worked a lot with nonprofit entities, including churches and schools. We've also seen a lot of our pipeline come through in the form of mixed-use real estate, golf and country clubs, medical facilities, and so forth. To date, we have nearly 100 projects completed, spanning 18 states, and over 500 million in contracted distributed generation in our nearly 13-year operating history. So on to EV charging. I definitely don't have to tell all of you current employees in the renewable energy space that EVs are and have been increasing in popularity. What may not be as much public knowledge is the lack of public charging infrastructure. My colleague Clifford Chang will divulge some of the recent data on EVs on the road today and the ratio to public charging available, but it's pretty staggering. And by installing EV infrastructure, there's a lot of benefits that a site host will see. The first one, and the most important, revenue share. That's right. They will get access to a percentage of the revenue share that comes from the charging stations. Generally, that number is 10%, but may vary based on the specific location. And they'll get access to this without participating at all in the capital stack. That's right. No investment needed. We'll work with you, the installer, to get the project built, and SCF will maintain these projects for the life of the term. And given that our solution is contingent upon us owning and operating, we're highly incentivized to be on site as soon as possible for any equipment that is impaired. So with a couple of new and shiny public charging stations, a property owner is going to attract new customers, whether it's a shopping plaza, grocery store, restaurant, or gym. An EV driver is more likely than not to use the facilities, if you will, and check out your establishment while their vehicle gets a fast charge for 15 to 30 minutes. And if it's a location that seeks new customers, then it's a win-win. And finally, and this goes for EPCs and site owners alike, SCF has strong financial partners. As you can see on our website, one of our primary funding partners is NextEra Energy, a company with over $150 billion in market cap and approximately 58 gigawatts in generating capacity. SCF has operated in this space with reliable partners for a while and will continue to do so. Now, EV charging revenue aside, our core offering for a significant period of time was the PPA, or a power purchase agreement for those unfamiliar, and it continues to be a backbone for every solution we offer. So while we can always take a look at standalone solar and solar plus battery PPAs, a real differentiating solution for your customers is a solar plus EVC solution with an allocation of solar purely dedicated towards the customer's host load, typically at a 10% discount as per the market average to their current rate of energy. So not only do they see the benefits of EV charging revenue, it can also reduce their electricity spend. A true win-win, no risk opportunity for the site host. And the benefits look very similar. Reduce operating expenses, they're not paying for it, so no upfront costs. And SCF is similarly highly incentivized to be on site as soon as possible if the system is underperforming to its potential. And let's say there's a scenario where the EVC utilization underperforms and we aren't quite getting what we expected or initially forecasted. Well, the customer still wins because they're going to see a significant increase in NOI due to the PPA. So they're paying less for their energy and they're seeing benefits regardless of how the EVC utilization looks. So in summary, zero risk, all upside. And if I'm a site owner, I'm not sure what else I'd be looking for. With that, I will pass it off to my colleague, Clifford Chang, who will talk a little bit more about why we were so confident in this solution.
Thank you, Matt, and thank you for everyone in attendance today. My name is Clifford Chang, and by way of background, I have been in the renewable energy market since 2009, specifically focused on the EV charging sector since 2019, and have seen many changes in the marketplace since then. As you will see, this slide illustrates the exploding demand for EV charging infrastructure. The stats list the number of EVs and the record level of adoption and the corresponding need for public charging infrastructure. So starting at the top, EV sales up almost 50% since 2022, just 2 years ago. 7.6% of all cars sold in the U.S. are now electric vehicles. Certain states such as New York and California have mandated that 100% of new car sales must be electric by 2030. The statistics for public charging, you will see 140,000 out of 183 chargers available are slower level 2 chargers, and only 43,000 fast chargers are in the market. If you take that number compared to the number of electric vehicles in America, 3.3 million, the ratio is 18-1 and much higher if you eliminate the level 2 chargers. Public charging grew by 40% last year. And clearly, the pace of infrastructure is not keeping pace with the number of vehicles being adopted. So this is a tremendous need, but also creates a tremendous business opportunity for property owners to drive new traffic to your sites, create new revenue streams, add an amenity to your property that competing projects may not have, and create a financial windfall, all by serving the public. Next slide, please. This slide illustrates what makes a great charging site. As you will see on the right, what types of properties are ideal for EV charging infrastructure. I think ideally you would want a site where there's high traffic. People can stop in for 20 to 30 minutes, charge their cars, and conduct other business or errands, such as getting their groceries, getting coffee, working out, etc. Workplace and office buildings are also ideal locations. People come to work, charge their cars while they're at work, and have a full charge ready to go, especially for those who commute long distances to work. This is an ideal situation so they don't have to stop somewhere along the way, on the way home or on the way to work. Shopping centers, again, are ideal locations. Multifamily buildings where the tenants may not have the opportunity to plug in at home as someone would in a single family are also ideal locations. Some of the other factors: high EV vehicle adoption, high traffic rates, proximity to freeways or expressways so that commuters can easily exit the freeway, stop off, charge their car, and get back on their way to or from home, such as you would stop at a gas station on the way home. Where would these chargers be located? Typically, those would be in the parking lot. Top floor of a parking structure is also an ideal location, coupled with solar, where you could create a canopy and shaded parking where normally those spots are undesirable because they sit in the sun or are exposed to other weather elements. This next slide illustrates the economics of a sample project. This project assumes 8 DC fast chargers, solar and energy storage coupled in that system. 10% revenue share. These assumptions are based on 2.5 hours of utilization per day at a public charging rate of 48 cents per kilowatt hour. As a point of reference, a typical EV requires 60 to 70 kilowatt hours of charge to fully charge a battery. So the average charge you would expect at a site would be 50 to 60 kilowatt hours, which equates to approximately $25 or $30 per charge. You will see that the revenue in year 1 is $61,000, hitting a levelized amount in year 3. This allows for familiarity with the site, other factors that will increase usage over time until we reach a levelized amount in year 3, which you see is roughly $100,000. Correspondingly, if the usage exceeded the 2.5 hours, the revenue share would go up accordingly. So if you had 5 hours of charging, that $100,000 would be $200,000. Anyone who has seen a Tesla public charging site knows that there are cars morning, noon, and night, and their utilization probably averages in excess of 10 to 12 hours per day. So the opportunity is very attractive. You will also see PPA savings. This is in the event that nobody uses the chargers or the utilization is less than estimated. Although this is a highly unlikely scenario, it is illustrated here. So any electrical generation not used by the chargers would go back to the host property and offset their current electrical demand. For each project, there is a break-even point or crossover point where the generation would go from the building 100% to the EV chargers, and we can calculate that for you on a case-by-case study, but it is usually somewhere between 1 and 2 hours. Based on this example, you will see that the revenue share over the 30-year term is over $6.5 million. That's assuming a 3% increase in usage over time, which is very low. 3% of 2.5 hours is just mere minutes and less than 1 car charging at any particular time. So each year, if only 1 car, or rather 1 additional car came to charge, you would realize these projections. The PPA savings are also illustrated over 30 years at 1.2 or 1.3 million. Again, if there were no savings because the generation went to the chargers, your revenue share number would be much higher. Public charging rates are also expected to increase over time, so our projections are very conservative, and you should easily meet or exceed these projections at your own property. At this point, I will turn the presentation back over to Matt, and I thank you for your attention.
Thanks, Clifford. Now let's take a quick foray into how you an EPC or developer might price a project like this yourself in the SCF Suite. So I have the SCF Suite homepage here, and if you follow my mouse, you'll see I'm going to start the process of submitting a new project by hitting the Quick Quote button in the top right-hand corner of the screen. From there, I'll select EVC Revenue Share and start filling out my project information. And as I fill out some of my project info, I'll speak over the important metrics we are considering in our initial projections for a location. You'll notice some fields have red stars next to them. These are some of the inputs that will have a significant effect on project viability. Inputs like the system size and output, term length, build cost, and property type. Starting with the zip code, a site that's located in a zip code with a higher median income, population, and EV growth rate is going to have more favorable revenue projections. Furthermore, if that site is a shopping plaza or a grocery store or restaurant, locations where people often spend a 20 to 30-minute visit, perfect for fast chargers, will also yield more favorable revenue projections. And if that site is close to a highway or interstate and is less than a mile from that highway or interstate, it's going to be a site that's more likely to be frequented and less likely to see EV charging competition in the future. So once I have all my information uploaded, I have selected my EVC program administrator, which is essentially the utility, and will allow us to accurately solve for the expected energy storage system size on the back end of this model. And you've let SCF know how much you're expecting to offset at the customer's facility with this solar system size. And in this scenario, 100%. I can hit calculate and voila. Number of chargers, year one revenue share, and estimated total revenue share over the term. You can verify the assumptions we utilized here with the EV usage and solar PV degradation. And from there, you can create the project. Once you create the project, you're able to generate a proposal and present to your off-taker all in a matter of minutes. Now, the Quick Quote is just one of several features the SCF Suite has to offer. If you'd like to see more, please reach out to us, register for the platform. It is free, by the way, if I hadn't mentioned that prior. From there, we can take a closer look at your project, collect any and all information we need before submitting for review. Assuming a standard non-complex project opportunity, we can have pricing back to you in a few days with the term sheet coming as soon as the prospective customer shows interest. With a fully executed term sheet, we can then set up a kickoff call to establish a project timeline and complete any other diligence items as needed, including but not limited to a financial underwriting. Generally, we'll ask for the last 3 years of audited financials. We can then have a contract signature for the customer and proposed EPC all in a matter of a few weeks once that's completed. And in a world where utilities can have an impact on project development timelines, we make a concerted effort at Sustainable Capital Finance to control the controllables, if you will. And that's our webinar for you today. Hopefully you've had a chance to learn a little bit more about SCF, our solutions, and how they can add value to your existing and future pipeline. We'll go ahead and take a minute or so now to allow some questions to come through, and we'll answer as many as possible to the best of our ability.
A question on considering EV only and level 2 chargers. So as of now, we don't have a solution or haven't incorporated a solution with just chargers. Having that PPA revenue backbone is kind of a formidable structure that we've had a lot of investor interest with. So I would say for now, there would need to be some sort of solar PPA component, even if that's not a significant amount, even if that's just 100 kilowatts. Some element of having a solar kind of backbone to the structure is something that we feel we can deploy at a scalable level. And then when it comes to level 2s, we'll look at captive usage at a site. So if there's a situation where apartments have been a good, HOAs, apartment complexes have been good test cases for level 2s, and what we'll ask of you, the developers / EPC, to do is kind of put together some data for us. So how many people are driving level 2 EVs? Do they have level 2s available currently? how many people are likely to buy an EV in the next year or so, specifically if there aren't level 2 chargers available. I know if a lot of people are renting, there's good scenarios where they don't have access to level 2s very, very easily. And so that might be something where they're more likely to buy an electric vehicle. So I would say that in situations where we have that, we would like to either put together a few level 2s and maybe have 2 fast chargers for sort of a level 2, level 3 combo solution. But if the captive usage is, very bullish and we see a lot of, potential utilization, we can look at a PPA plus level 2 only solution in the right scenario. I have a question regarding financing options where the customer owns the PV and or the chargers. We do not currently have an option for that. We look to own, operate, take advantage of the tax credits, low carbon fuel standard credits, whatever credits that we can take advantage of and pass on to the form of savings and or revenue share to the customer. It's kind of what we're more interested in for the long term. So that's kind of where we've stood with that option, but can obviously work with differing property types based on, kind of who has maybe a bigger need for not putting up upfront capital for these solutions is kind of the ideal property type or owner operator that we're looking to work with. Another question here. So given that this solution is primarily focused on having a solar component, we would like to work with you guys as an EPC specifically on the solar side. If you have EV charging installation experience, happy to underwrite sort of the projects you've completed, the types of chargers that you're building or installing essentially, whether level 2, level 3s. We have a few different installer partners that we've relied upon over the last, I would say, 12 months or so that we know can build to the quality that we're looking for these sites. But I would say that every component of these deals is going to have a solar component, in which case we expect you bringing a deal to us likely can build to that standard we'd expect on the solar side. And then if you have experience and would kind of like to undertake the scope on the EVC side, we can definitely take a look at your statement of qualifications if you have one, and then completed project examples, any project references for those completed projects would be kind of what our standard underwriting process would be for an EPC partner. So happy to take a look at your capabilities and then obviously incorporate them into the project. If you're bringing the off-taker to us, we're going to honor that, either within an origination type role and getting paid out as a fee for that, or taking over the entirety of the master primary contractor role and kind of taking advantage of building it as well. So I had a question regarding the smallest PV size we would consider for EV. I would say for us, 100 kilowatts is a good number. We're going to need the PV to stand on its own on some regard. So doing projects as low as 50 kilowatts tend to be a little bit more difficult depending on the site itself. If we're in a really bullish location for charging, utilization looks high. We're in a good city, and the zip code data kind of reflects this is a site that we want to be at for charging stations. We can look at as low as 50 kilowatts. I would say most of those projects are going to be tougher to pencil, but we're happy to take a look. And if it's a location that it's right off of an interstate, good zip code information and data that we're looking at, I would say those scenarios we can definitely look as low as 50 kilowatts. But I would say for comfortability of us taking a look at your site, I would say 100 kilowatts is kind of a more firm minimum that we can work with. We consider chain stores. So yeah, chains are great. We've looked at a lot of quick service restaurants over the last 12, 18 months. Taco Bell's, we have a site in operation with a Taco Bell, but we looked at Ashley's Furniture Stores, we looked at Walgreens, we looked at, like I mentioned, quick service, every type of quick service you can imagine. They tend to have smaller parking lot sizes, which can sometimes have a kind of a restraint on this type of solution where taking up a few parking spaces and or planter area for the battery, incorporating 4 to 12 chargers. That's going to take up a few parking spots. So there needs to be some sort of collaborative effort there with the property owner to kind of know where we can build and where they're comfortable building at. But I would say for the most part, working on that kind of scale where we might have 6 to 10, 50 kilowatt size projects, we can scale that and offer portfolio level pricing that's a little bit more competitive than just a one-off 50 kilowatt opportunity. We'll definitely get this webinar, a copy of this webinar out to all of you. So that should be in your inboxes the next few hours. Had a question regarding multifamily apartment complexes. So kind of similar to what I had mentioned prior, where fast chargers aren't always the best solution for that type of offtake. We can definitely try to put together some sort of level 2 solution where we take a look at some of the captive usage data and see if there's some component that we can support 2 to 4 level 2 chargers, and then look to offset some sort of common meter, whether it's a main administrative building or the main lobby for the multi-family complex. We can look to offset that main host load versus setting up multiple interconnections across the apartment complex. And then what we'll usually ask of that type of property owner is there will be some sort of minimum threshold that we would need to hit from those level 2s. So if we go through the effort and the process of putting together a few level 2s based off of the captive usage that was provided to us, we don't hit those metrics on a pretty consistent basis, there might be some sort of minimum payment that we would ask the property owner to essentially compensate us for if we weren't to hit those thresholds. Those obviously would be in the worst case scenarios, but we can definitely take a look. And for those types of situations, I would mention if there's some interest in public charging, that makes things easier. We can kind of do a combo solution. But if that's not on the table, which sometimes it cannot be, specifically if it's gated, we'll look to have public access to these chargers year round. So if there's a gated component to the facility where they're less likely to kind of lift that, we can definitely try to take a look at level 2 only for those types of properties and see if there's a solution we can put together. Go ahead and see if we've got any other questions here. I think that's kind of what the most that we've gotten here. So go ahead and, I think we're over our time anyways. So go ahead and let you guys have a great rest of your Tuesdays. Any other questions, feel free to reach out to me directly. We'll make sure that a copy of this webinar gets out, and we'll reach out to you guys individually over the next week or so to hopefully connect and discuss how your current and or potential future pipeline could align with some of these solutions. But we appreciate your time today.